Abu Dhabi, for example, there is now a movement towards carbon tax, carbon reporting, etc. All of that. So you create also immediate kind of both incentives to an economic value for people to actually do that, to see returns. With any new technology, you need to balance, right? Because let's say when kind of Meta went all in into the metaverse in extremely aggressive way, and then that technology hasn't come into play in the same speed, that had a massive kind of negative impact on the performance and the share price. The UAE and Saudi as one of the most kind of active capital markets across the region.
Good morning, everyone. Welcome back to the Diaries. We took a little bit of a break, but now we're back here to educate you and educate ourselves. We're really glad to have Youssef Salim on today. This brilliant man is the CFO of ADNOC Drilling, the co-founder of Cora 71, which is a Hub 71 official venture syndicate partner, and a freshly minted member of Forbes 30 Under 30. Thank you so much for being on here, Youssef. Can you walk us through your career and how it led to your trajectory of getting to CFO of ADNOC Drilling at such a young age?
Absolutely. So I'm Egyptian. I studied at the American University in Cairo, did an internship with Q Invest, a Qatari investment bank, while I was at university, and then joined them full time in 2012 after I finished university. Q Invest is like a merchant investment banking model where you basically do both advisory sides. Obviously, you worked with different kind of clients, SWFs, family offices on different transactions, buy sides, sell sides, kind of restructurings, capital markets, etc. And then also we had our own kind of prop book where we do principal investments, both private equity and private credit out of the bank. And then in 2016, I moved to Moelis & Company. So Moelis is a US-based investment bank, and I was based in Dubai in the office covering the Middle East and North Africa. Focused predominantly on energy infrastructure and technology. So 80% of the time spent kind of advising energy and kind of government companies. So ADNOC, we did for them the advisory on the 6 listings of ADNOC subsidiaries, a lot of the M&A they've done, Aramco as well, the kind of the M&A program, post their IPO, etc. And then 20% of the time spent on technology companies, Series B, C, pre-IPO and IPO kind of fundraisings. In 2021, I converted that role with Moelis to a part-time advisory role, and I joined Swvl, which is like an Uber for buses, which was one of the clients I was advising out of Moelis, joined them as CFO in 2021. We took it public on NASDAQ in 22. And then in 2023, I converted that role with Swvl into a board role, and I joined ADNOC, which again was one of my main clients on the Moelis side. First, the CFO of AIQ, which is ADNOC's AI arm. At the time, was a JV between ADNOC and G42. We sold the controlling stake in AIQ to Presight, which is an ADX listed, Abu Dhabi exchange listed AI company. And as part of that transition, I joined ADNOC Drilling, which is the Abu Dhabi exchange oil field arm of ADNOC.
Awesome. That's a very impressive list.
Thank you.
And yeah, we will get into the AI definitely in a bit, because that's something fascinating that we want to get into in terms of the landscape.
Of course.
I think we covered how structured the cost benefits previously of structured learning in developed markets versus, unstructured, but various asset class learning in the Middle East. Let's move on to Moelis then, right? So when you're at Moelis, you're covering multiple big clients, government-based clients as well, Aramco and ADNOC. Then there's a small portion of time that you're dedicating to fundraising and Series B and Series C. So typically when you're looking at these, I'm assuming this is, of course, you're reaching out to investors and you're asking them for term sheets, right?
Yes.
So there's a completely different, almost almanac of knowledge that you require when you're looking at startups, especially if it's early stage or like mid-stage Series B and Series C, compared to mature companies that might require growth equity infusion or just exit sponsor to sponsor with the private equity firm. So how did you tackle those two different elements?
Look, at the end, there's a lot of common fundamentals, right? At the end of the day, the investor that you're reaching out to, whether it's a growth equity or a startup, one has a specific investment mandate and the strategy that you basically kind of have to make sure that you kind of present this in a way that fits that, whether that's a strategy in terms of the target returns they're seeking, the geography, the stage, the amount, the teams they're looking for, the type of returns, etc. Second is this investor would have a certain internal stakeholders, whether that's an investment committee, an LPAC, kind of a board of directors, etc. And they would kind of look at things in a certain way, and we have to tailor the story towards that. Third is investors would either be looking for growth, dividends, or a combination of both, right? So ultimately, that kind of, yes, maybe it's a rapid growth if it's an early stage, maybe it's moderate growth if it's a bit later, and maybe it's a combination of growth and distributions if it's, let's say, late stage or public listed, but that's kind of the combination ultimately they're looking for. And then there are a lot of common things, right? Like market size, the strength of the team, the growth story, the competitive positioning, let's say the technology angle, the track record. So Yes, there are obviously differences, but at the end, there's more commonality than difference. There's a story, that kind of your storytelling of why this asset makes a ton of sense and why it fits within their investment criteria and why it's at this inflection point where it's about to kind of take off in a very unique way. And you're basically trying to kind of balance, on one hand, a very attractive story and narrative that excites people, that creates a kind of FOMO, that kind of wants people to come and be part of it. And at the same time, a numerical story that basically kind of substantiates the storyline with numbers, with data points that show that the business, whichever stage it is, but has, again, strong growth, strong profitability or attractive profitability, strong kind of retention, strong cohorts, strong operational performance.
Yeah, I feel like you just read out the titles of slides because a lot of what you do in investment banking is creating these storylines, right? There's narratives in PPT or Excel or whatever it is where you're promoting this idea of, hey, this company is good and it's ready for that inflection point that might be hockey stick growth, or it might provide you a dividend that you require. But moving on into, the kind of investors you're looking at, is it similar? Because this region is quite, like you said, the lines are blurry here, right? So there's a lot of corporate venture capital that's coming into play. Because, for example, there was a little conference, little roundtable at North Star a few months ago, wherein a lot of companies came in and said, hey, we want to do corporate venture capital. Help us figure out how we can do bolt-on acquisitions or some kind of M&A to help, integrate into our value chain, but also diversify our product streams and our geographical streams. So what kind of investors are you looking at for Series B and C? Is it the same family offices that would do growth equity or like bigger plays with private equity? Or is it smaller venture capital funds that you look at in this region that are localized?
Absolutely. I think on your first point, you're absolutely right. That whether you're doing a slide, an Excel, a verbal presentation, etc., at the end, it's all about what's the story, what am I trying to say, what's the takeaway, right? Because anything you're saying or putting, you're trying to sell in a way, we're trying to deliver a message, we're trying to get someone on board, and it's all about, okay, what is it? What's the takeaway? What's the 30 seconds I'm trying to leave someone, whether it's from that slide, from that tab, from that kind of sentence I said, etc. What am I trying to kind of leave them with? And that's kind of how, as you're developing these materials, as you're rehearsing, as you're coming up with them, that's what you always have in the back of your mind. In terms of the investor stage, so typically in the region here, obviously in the pre-seed, seed, and to some extent Series A, you have plenty of regional VCs, and these regional VCs tend to be backed by sovereign wealth funds, pension funds, and funds of funds. And a lot of it is government backed, because obviously government has big mandates to kind of promote the venture and the entrepreneurial ecosystem in the region and increase in general kind of private sector and SMEs and startups contribution to the economy. As you get into kind of your Series B, C, one of the challenges you have in the region is this space starts to kind of reduce and become small. And this is because you don't have a lot of, if you go globally, similar to a lot of the early stage VCs, you have a lot of the late stage and the growth capital VCs who also focus on that space. In the Middle East, you don't have as many of these because obviously these start requiring larger tickets, etc., which are kind of less prevalent in the region. So you end up with a combination of, you have some sovereign wealth funds who have set up specialized subsidiaries for that. For example, in Saudi, PIF have set up Sanabel to do some of the earlier stages. So that's
ventures.
Exactly. So you have some kind of specific setups coming out of the SWFs to do that. So that's kind of one area. Second is you have some of the early stage guys effectively pushing to do either growth SPVs or growth funds. Right? So you have, for example, Becco, which is an early stage VC, coming up with growth platforms to try to do a bit of later stage. Then you have some of the internationals who come in. So people like General Atlantic, etc., who come in and do some of these deals in the region. So that's kind of another thing. Then you have deals which are family offices, as you said, coming in. Now, with family offices, obviously, there tends to be focused more on more profitable or immediately profitable or pre-IPO businesses, but that's kind of one. Or five is specific bespoke setups, right? So you have someone who set up a specific SPV, a specific kind of one asset fund, a managed account to kind of do a specific deal. So these are some of the different kind of pockets of capital that come in for this stage.
Yeah, absolutely. I feel like in the previous conversation, we were talking about how, even in general investments here, it's typically co or direct or sovereign wealth funds, right? And now you see these bespoke firms coming up, like Alif had their recent, fundraise, and they're looking at sort of reinvigorating private equity in this region because it's actually run by someone who used to be at Abraj. And they're trying to bring back private equity as a conventional kind of investment in these markets here. But then what about exits then? Because, if you were helping with fundraising, I'm sure you helped with divestment as well. And we're looking at, for example, as you mentioned, General Atlantic, they recently did the first ever secondary, VC kind of exit with Key Capital a few months ago. But there isn't a space where venture capital firms can go and exit unless it's to a sovereign wealth fund, or unless it's to a strategic player, or like a listing itself. But that's extremely rare. At least it has been for the last few years. So how does exits look?
You're absolutely right. And this was the main kind of challenge we had during the 2010s. And that's the reason why private equity never really took off in the way it's meant. Because if you can compare it to Europe or the US or different parts, one is you'll have a lot of PE to PE deals, but that's by definition requires having multiple of these PE deals. Second, a lot of capital market exits, which historically hasn't really been the case, as the capital markets were not very active in the kind of 2010s. And then strategics being very active on M&A, which again, historically has not been the case, because companies were kind of mostly trying to maintain relatively low leverage, business as kind of usual, and not kind of get into very adventurous things. And that's why exits were very difficult. And then the fourth thing is to try to do kind of buybacks using a lot of leverage, etc. And again, that kind of the financing market overall is very conservative, right? So compared to, again, if you look at the US and Europe, where you will have big LBOs, where you have multiple debt tranches and mezz and etc., you don't really have that. So that's why you had a lot of slowdown, and with the exception of maybe kind of Gulf Capital, etc., trying, there wasn't really a lot of funds. Obviously, you had the challenges with Abraj. And then you had a lot of like deal by deal players who like Investcorp, Fajr Capital, who succeeded by saying, okay, we're not going to do blind pools because investors are not comfortable committing to blind pools. Because what's the problem? As you said, from the end, you don't have exits. If you don't have exits, then the returns are not great and the liquidity is not great. So then people become more kind of nervous to commit to blind pools, and it becomes more difficult to raise money at the front end. So then doing these kind of deal by deal SPV, and that's how Investcorp propelled into tens of billions of dollars of AUMs by saying, okay, you know what, it's too complicated to raise a fund. Let me focus more on deal by deal, where I can get people to say, okay, you like this specific asset, forget about the overall kind of PE industry and what it looks like. I think over the last couple of years, this has changed in many ways. And the outcome of this change, as I said, is Alif, is Jadwa, is some of these kind of PEs coming in. And the change. One is obviously capital markets boom, right? You have the UAE and Saudi as one of the most kind of active capital markets across the region. And hence now the path to exit via listing is becoming very real. Whether on the tech side and the VC side, where you had in Saudi, you had Jahez, you had the Nice One, you had Rasan, the insurance company, whether it's in the UAE or Talabat, etc. So you have now a capital markets which is vibrant and is working. You have the strategics becoming more active, because now a lot of these strategics are also starting to become propelled and backed by specific government mandates. Right? For example, when a lot of these assets were transferred from the UAE government to ADQ, and ADQ developed very clear strategies, then the corporate players under ADQ, whether it's Aghdiyah, whether it's in the F&B space, whether it's Taqa in the power space, whether it's Abu Dhabi ports in the port space, they started to have very clear strategies, and hence they become more active from an M&A perspective. So all of this created more activity across the, and that's why now you see PEs are starting to come in, because that's pathway to exit, which is the key thing, is becoming more available. And then secondaries, as you said, yes, historically, secondaries were very difficult. So you needed to wait for the entire company to exit for you as an investor to exit, which should not be how it works, because a lot of times the majority shareholder or the founder wants to keep running because there's still so much upside. But you as an investor, your early stage, your timeline has ended, and hence now you need to exit. So now you're starting to also see more maturity in this. So for example, one of the examples you mentioned is Key Capital, which is a new fund of Bassem Muftah. So it's basically focusing on specific buyouts, right? So they've done the first deal, they're closing the second deal. So that started to create liquidity in the VC space. Then you also had, for example, the Beko Property Finder deal, where Property Finder raised debt and bought back the Beko shares. So again, that's another way of creating a secondary event. Then you have one of the asset managers in Saudi. What they're doing is they're combining 3 assets together, creating a fund and listing that fund. So you have, effectively, now you have the DFM, the Dubai Financial Market. They're partnering with LSE to introduce an OTC, so a secondaries-like market, a bit like the AIM, the parallel market in the UK, bringing this idea to the UAE to have an OTC-like market. So it's, as you said, it's very critical to create liquidity at both levels, at the ultimate company exit level, but also at the secondary level within the kind of the life of the company.
No, absolutely. There's a lot to decompress there. The first one being, yes, fundraising is, I think, a lagging indicator, right? So there will not be very few blind pools, because fundraising, typically you see later that fundraising is tough because the exits aren't happening, right? Exactly. So it's a deal by deal basis. And I think companies like Investcorp did a really good job, because not only did they do deal by deal structuring and they went to different players, but also they said, hey, we'll make it Sharia compliant. And we'll focus on that element as well, which a lot of companies are now getting into, but that was a key consideration to begin with. And I think in terms of the private equity market itself, right? So for example, they do this OTC kind of structure here. But there's different elements across the world that are coming up to give liquidity to private markets, right? And to democratize access almost to retail investors. For example, let me just run this by you. Because this is a thought I had recently, right? Like if you read Bain Capital's recent private equity report, it says 28,000 buyout funds exist in the world. There's about $3 trillion of assets under management that are yet to exit. right? Additionally, a lot of debt that they've taken on as these LBOs or even MBOs sometimes is coming to maturity in 25 and 26. A key consideration also is that 50% of the world's wealth remains retail. It's not only institutional. So what certain companies have done, for example, Moonfair, and stop me if you know what Moonfair is. But for example, Moonfair, they've basically fractionalized LP investment, right? They've decreased the ticket sizes and they fractionalized and allowed people to get liquidity through that. Would you see a concept like this succeeding here? And my initial thought is no, because sovereign wealth funds control most of the assets here. There is no debt crisis for them. There's no liquidity crunch because they will, they're flush in that sense, right? So would you see a concept like Moonfair, as familiar as you are with it, working in a market like this?
Definitely. So I think break it down because a few great points. Right. I think one, Sharia compliant, you're absolutely right. This allows you to attract much more liquidity, not only on the private side, now even on the public side. So recently, the Abu Dhabi exchange with the FTSE, which is part of the LSE business, the London Stock Exchange, they launched a Sharia-compliant ETF, exchange traded fund, and index in the UAE. And obviously that's very critical because you have a lot of money, whether in Saudi, some in the UAE, some in Southeast Asia, Malaysia, which would only invest if it's Sharia compliant. So having that kind of Sharia compliance piece becomes very critical to attract additional capital. Now, to your point, markets which have more retail, like for example, if you look at the US or even Saudi in the region and compare them to some of the other markets in the region or elsewhere, the reason the US and Saudi have much higher liquidity and valuation, some of the other markets, is because the majority of the trading is retail. If you look today at the US, if you add retail plus quant funds, kind of and other kind of quantitative and technical strategies, they're actually more than the trading by them is more than the fundamental traders. And hence that kind of that's what creates a lot of liquidity in the market and basically kind of helps boost trading and valuations. So that is very, very critical. And obviously there is a ton of public products on the retail side. And that's how people like BlackRock, iShares, etc. That's how they massive. And you saw, for example, on the Bitcoin, once you had the ETF come in, that kind of drove the price increase from 70 to 100. So that ability to bring in retail and use ETFs and use very cheap products has completely kind of transform the public markets. And now, as you said, it's about how do you bring this experience to the private markets, right? And this is happening, obviously, as to your point, with people like Moonfair on the private equity side. And that's great because you're providing access to products that people would never have access to, right? Because if you look at the minimum ticket of these big funds, and hence a lot of times today, what kind of retail, the problem that retail has in private markets is that asymmetry, is that they get kind of, and that adverse asymmetry where they get access to whatever small things which are left. And then second problem is the regulatory problem, right? Is that how do you market to retail? Because obviously it's a very kind of sensitive topic from a regulatory perspective. And we've seen significant fines in the region on people who have attempted to market in a regulatory, in a retail. Exactly. Yeah. So if you today have a structure that allows people to kind of be from a regulatory compliant, but at the same time provide people access today on, as you said, on Moonfair, that with a small ticket, you get access to the top KKR Carlyle funds that you wouldn't be able to access otherwise. And we're seeing it on the VC side, right? So for example, today you have a lot of fractional, either on specific asset classes, for example, fractional real estate, right? Mm-hmm. That's kind of becoming a big theme. Even fractional investments into, for example, now there's a sports fund run by Hadi Halabi where he makes investments as low as $1,000 in specific. For example, he has now Watford, the British football club, available where you can invest as little as $1,000 in Watford, right? And that's regulated by the DFSA. Mm-hmm. So you have that ability to enter into assets otherwise you wouldn't be able to enter into. And what that does is allows that same kind of the same way public markets have become democratized for everyone. Where you have today, for example, in public markets, you have Thunder in Egypt, which has become the biggest broker in Egypt. It's like Robinhood in Egypt. And now effectively 80% of their investors are first-time investors in public markets and 50% are from outside the capital. So you have the ability to really democratize public investing. Now the same exact trend is happening on the private side. Now to your point, on the more sovereign wealth funds, on the larger assets, on the large asset managers, they have access to funds, they have access to capital, they have the debt they need. That's not a problem for them per se. But you have a lot of the retail and the private, which don't have the same, and hence that ability to provide them access becomes very critical.
Yeah, I think the major consideration with this is just to your last point. For example, sovereign wealth funds, they are cash flows. They don't have to worry about liquidity crunches. But see, for example, if you're democratizing access to private markets, and if it's private equity or private credit, whatever it is, you are essentially you're allocating, right? You're doing a fund of funds.
Yeah.
And so you got to pick these funds, and the funds will typically perhaps not be government backed.
Yeah.
They might be family offices that might have like an organizational structure, might be regional or multinational, or there might be these newer funds coming into play here, like General Atlantic moving here, Brookfield moving here, et cetera, et cetera. So it might be now that these new funds are coming in and they start fundraising, that there is the ability for a new player to come to the market and say, hey, we will allow more access to retail investors to private markets through these new fundraisers that
100%.
international funds are doing.
100%. You have one, not necessarily for retail, but even for smaller professionals, even some of the professional investors who maybe can invest a certain number of tens or hundreds of thousands of dollars, it's still too small for the minimum ticket. Mm-hmm. So you have, for example, a fund of funds called SVVI. What they basically do is they kind of go for professional investors where they want to put 50K, 100K, still below the minimum ticket for a fund, but then they kind of pull this together and put this into the funds, right? And that's proving very attractive because they're able to access Andreessen, etc., and Sequoia, etc., which funds which will not be able to access from here with a small minimum tickets.
Would we be able to implement Sharia-compliant ETFs in other regions?
Absolutely, implement anywhere, because at the end of the day, it's all about meeting the characteristics of the company, right? Yeah. So you shouldn't have a higher percentage of your revenue coming from non-compliant activities. Yeah. Your debt should not be higher than certain conventional debt, should not be higher than a certain percentage of your market cap. Your cash should not be higher than a certain percentage of your market cap, etc., etc. So once you meet this criteria, any company, and obviously the type of activity you do, as long as you meet these, any company in the world can effectively potentially be Sharia compliant. And then what that does, once you have that stamp, that label, that opens for you a lot of funds. And these funds would not go and on its own, and then they don't have the time or the resources to go and check each company and form their own.
Are these institutional investors or retail investors?
So these are, they're both. So on the institution side, these can be treasuries of Sharia compliant banks, for example, Saudi banks, right? Yeah. Malaysian banks. These can be family offices who, for example, Eastern Province in Saudi, different parts which are kind of more Sharia cognizant. These can be takaful companies, so Islamic insurance companies, cooperative type insurance companies. And they can be as well retail investors who want to invest in Sharia compliant. So all of that effectively group of investors you don't have access to if you don't have that stamp. Once you have that stamp, you're having incremental liquidity. The same thing as the sukuk, the Islamic equivalent of bonds, right? If you're an issuer, for a long time, sukuk has traded effectively at a higher price, i.e. a lower credit spread or interest rate compared to, or profit rate in the case of sukuk, compared to a bond. Why? Because you have all the same investors as the bond, but then you have incremental investors who could not invest on the bond. Whenever you're issuing any security or any instrument in the world, what you're trying to do is trying to maximize demand, right? Why do, for example, some issuers in the region, they go and they issue Japanese yen bonds, right? Because they want to get access to the Japanese liquidity, which would not come in dollars, certain part of it. So it's all about creating as many instruments as possible. Why do you, for example, go and do a secondary listing somewhere else? You go and create global depository receipt, American depository receipts in the US. What you're constantly trying to do is get that last dollar of liquidity out there and basically take your company and then tranche it and create all sorts of securities that specifically tailor for specific investors.
So you basically create that intention to invest in ETFs, Sharia-compliant ETFs. And would crypto be considered Sharia-compliant?
They're very different. Depends on who you ask. I think there's a lot of different views on that because obviously...
Because Chorus 71, I saw they've recently invested in crypto.
So not directly in crypto, but one of the transactions we have upcoming is a crypto infrastructure play.
Right.
So it's basically a regulated business, which basically provides an exchange and white labeled wallets for telecom companies and banks, which allow people to transfer crypto, use crypto for payments as well, etc. I think with crypto, it's difficult to make a categorical statement because at the end, if you think about where most companies you do the assessment, a lot of it is about the sources of the underlying revenues and why that is coming from a type of activities. And then you're buying into effectively a share of that activity.
Right.
In the case of crypto, if you take the cryptos, especially the ones that don't have a utility like Bitcoin, there is no underlying economic activity itself to then classify as kind of Sharia compliant or not Sharia compliant, right? So then if you look at it more like from like an equivalent to a gold perspective, right? And that effectively that's what you're buying. So you're buying more of a store of value. Then that kind of becomes the alternative way to look at it. And then there's also an element, also whenever you're investing in something, there is two sides of the compliance. One side of compliance is what is the activity itself. And then second is the nature and the behavior, right? Because at the end of the day, Sharia compliance is also not about speculation, right? So if by definition you are buying an asset that from a speculative perspective, then that's by definition not kind of Sharia compliant from an activity perspective, right? So, but if you're buying it because you fundamentally believe in it as a store of value and effectively the same way you buy a commodity, whether it's gold or something else or a metal or a mineral that you believe is a store of value, then that becomes kind of a different story.
Just to continue on your LinkedIn post, it does speak to a personality that the CFO of ADNOC Drilling has, right? Because this is your personal interest where you want to educate people. And you also want to speak about something that is almost ingrained in you as a Muslim, right? Could you tell us more about, do you want to take this up formally, maybe be a professor in a few years, or or is this something you just like to do to inculcate values and knowledge to people?
Yeah, look, to be honest, like no grand plan, right, of where it's taking. It's more of, I felt that, okay, we have an opportunity to, at the end of the day, to showcase one that, look, there's a lot of very cool, very modern, very valuable learnings that we can get from our religion and from our kind of Quran that can be very relevant and kind of be very useful here. And we want both people who are Muslims to be able to kind of be proud of kind of what the teachings and what the religion carries and the learnings it carries. And also people who haven't necessarily read it before or are not aware of it, to also kind of understand that this is not just kind of a book about just kind of religious teachings. This is a book about life, right? About economics, about finance, about kind of everything and all of that. And kind of it can really add and enrich the overall conversation, right? And I truly believe that you only kind of prosper once you bring everything together, right? You bring all your sources, the local, the international, you translate this from here, you translate this from here, and you create this enrichment environment where all the ideas come together, and that's how you progress.
Interesting. And speaking of enrichment environment, almost like a conducive environment for progression, is this something you're also trying to do with Quora 71? Are you very hands-on with this? Is this sort of an ecosystem you're building that could be like an accelerator or a launchpad, or is it primarily just a deal-by-deal ticket kind of?
So what Quora 71 is, so I've been working with Hub 71 as an entrepreneur in residence for 3 years. Hub 71 is basically the incubation acceleration hub in Abu Dhabi, which focuses on both regional startups as well as international startups coming from outside, basing themselves out of Abu Dhabi global market, which is the financial center of Abu Dhabi, and using it as a kind of a springboard to interact, one, with the strategic players in Abu Dhabi. For example, if you're coming in as a biotech or healthcare player, you work with Cleveland Clinic, with M42, with Pure Health, etc. If you're coming in as an AI company, you work with G42, AI71, Precise. So you work with all the stakeholders, plus you raise funds from the Abu Dhabi environment, and the region, you basically hire talent from the region and use it kind of as a way progress. And I've been doing this in terms of working with the startups, in terms of mentoring, support on fundraising, on client introduction, channel partners. So what we work together with Hub 71 by introducing Quora 71 is saying, rather than only having the entrepreneurs and residents in Hub 71 support, we can bring in a larger community of executives, people from across the industry to support these startups, support them with investment, but also support them with mentorship, introductions, kind of to stakeholders, all of that. And that's how we've set this up. So this is a syndicate of basically people from across the industry, right? So kind of people working across all the big institutions across the region who are working on this. So the deal by deal is one side of it. And the totally unique thing about it is it's deal by deal with no management, no carry, no fees, no expenses, no minimum ticket, no commitment. So it's basically purely everyone coming together. Interests are fully aligned. Everyone is participating kind of with whichever amounts they want. Obviously only professional investors, because it's not open for retail. It's not a regulated activity, but that's kind of one side of it. And that's to promote kind of, again, access to investing and alignment of interest. But on the other hand, you also have the support and the value creation side. And yes, the idea of this to continue to grow kind of hand in hand with the Hub 71 growth. So Hub 71 itself is growing massively. They add a sustainability track, a climate track, an AI track. They have partners like Techstars, etc. So the idea is to grow hand in hand with Hub 71.
Very interesting. So I'm assuming there's no SG&A to take into account, right? Like these are not contracted professionals. You're just coming together as almost shareholders in a deal.
That's exactly the point, like to create a zero expense environment.
Right. And there's no class of shares, right? Everyone's coming in as an equal stakeholder.
Exactly.
So in that situation, for example, 5 founders with brilliant ideas, we want them to come here and we'll help them develop their ideas, but we'll also put our hands inside and take a piece of the pie.
Exactly. Skin in the game and align interests.
That's
exactly
that. Yeah, exactly. I really like that. Okay.
Exactly.
All right. Awesome. And in terms of AI, so you mentioned you work with Presight on AIQ.
Yeah.
And I'm sure you have a bucket list of questions about this. But I remember looking at Presight's deck for the investment criteria. It sent to that firm that I was at. What have they completed their fund? And what kind of acquisitions what kind of synergies did you see with AIQ and something like Presight? Because Presight was very focused on certain AI functions, right? So what was AIQ's mandate?
So actually Presight overall strategy now is predominantly focused on energy and finance. They do other things as well, but these are the 2 key biggest parts of their strategy. And obviously AIQ is a pure energy AI player, and hence kind of that very strong fit. AIQ's strength was the product. So kind of 100 PhD holders, product developers, etc., focused on creating these AI products. So a digital twin of the reservoir, an autonomous well, like an autonomous car, a smart eye, which is basically kind of a camera linked to a computer vision feed, etc. And Presight's real strength is their commercial, their go-to-market. So they have these relationships internationally. They have, obviously, in addition to the Abu Dhabi government, and they sell products internationally. So how do you bring AIQ's products with kind of Presight's commercial and go-to-market arm, and you put them together and you create the best of both worlds? In terms of Presight's investments, yes, they're very active. They also have multiple strategies strategies which they're unveiling over time. I think they already announced their accelerator program. They're also announcing a couple of strategies in Q1 of this year. So they're kind of performing extremely well, and they're investing extremely heavily. And everything from like early stage to kind of late stage to their ongoing operations. Today, they're effectively the largest listed AI company in Abu Dhabi. And then you also have with them, you have Space 42, which is also a listed AI company. And then you have private companies like AIQ, like Core 42, like M42, AI 71. So you have a flurry of activity in terms of AI. And it all links back to Abu Dhabi's and the UAE's strategy to be the kind of the AI leader globally by 2031, having the first AI minister in the world, having a lot of these kind of AI acceleration. Hub 71 now announced a program where they were providing the Hub 71 startups with access to compute and cloud, which otherwise would be very expensive. You have people like Amazon, Microsoft building data center capacity in the country. In addition to the data centers by Khazna, the local player, you have G42 introducing the sovereign cloud, which is basically a cloud plus a sovereign security layer to enable big companies and government companies who historically would have been very sensitive about cloud and would have wanted to keep their data on-prem to feel comfortable about putting their data. You have today one of the first kind of AI specialist universities in the world, Mohammed bin Zayed University for AI. You have some of the local LLMs, whether it's the Falcon model, which was developed by Khalifa University, TII, or JICE, which was developed by G42. So ultimately AI is about infrastructure, right? Universities, data centers, compute, cloud, LLMs, etc. And the UAE has built these applications one by one.
Or are they providing energy for most of the computing for this?
That's another great thing about the UAE, right? If you think actually about it, it's like where should technically data centers and AI sit? They should sit in places which have great access to energy at competitive prices, which the UAE by definition is. They should have places which have effectively a lot of stability and neutrality and kind of geopolitical stability to make sure that you're not impacted by anything that's kind of happening and people are not sensitive about hosting their data, etc. in your place, which obviously UAE has. Then you should need to kind of have AI in a place where this infrastructure exists in terms of compute and cloud, etc., which it does. So if you think about it, obviously from a location, from a time zone, from whatever it is, it has all the ingredients to be really that AI hub.
Is UAE or Abu Dhabi investing in nuclear energy?
You have ADNOC, the Abu Dhabi nuclear energy company. So they keep adding incremental capacity, investing in renewables. So Mohammed bin Rashid Solar Park, one of the kind of largest in the world. You have obviously Masdar, which is the renewable and the arm of the three-way joint venture between ADNOC, Taqa, and Mubadala. And they're reaching 100 gigawatt globally of renewable capacity, becoming a top 5 player globally. So it's kind of investing in new energy. You have now ADNOC investing with Exxon on hydrogen. So it's kind of nuclear and well beyond, right? It's all types of new energy.
This whole initiative is a part of sustainability in finance, right?
Exactly.
If you want the audience to understand what something about sustainability in finance and AI computation, what would it be?
If you think about, even from an ADNOC perspective, we always talk about like 3 major trends that we believe is about the next 10 to 20 years, right? AI, which we've obviously talked about. Second is sustainability and kind of an ESG. And obviously the opportunities it's unlocking for anyone today who's investing in climate, right? And whether you're investing in climate as in carbon capture, as in some of these kind of alternative energy technologies, etc. But that's the second piece. And then kind of the third piece is the global south, right? Today, obviously, with the massive rise of populations across Africa, Asia, etc., their demand for everything, commodities, etc., would increase massively. So how do you kind of do that in a sustainable way, right? So if you kind of are able to play across these one or more of these 3 trends, we see kind of massive growth in the next 10, 20 years.
And this is not in the MENA region alone, right? This is globally, everyone is looking towards sustainable finance. And as the CFO of ADNOC Drilling would portray that ADNOC Drilling is doing to as an oil drilling company, how are you guys initiating sustainable finance in your company?
So first you start with like very ambitious targets, right? For example, ADNOC as a group is reaching net zero by 2045, which is 5 years faster than most kind of operators globally who are targeting 2050. Then you set up intermediate targets, right? For example, ADNOC as a group is reducing emissions by 25% by 2030. So again, you cascade that to something close. Then you create the tools that incentivize people. So if you look at Abu Dhabi, for example, there is now a movement towards kind of carbon tax, carbon reporting, etc., all of that. So you create also immediate kind of both incentives to an economic value for people to actually do that, to see returns. So it doesn't only become a question of, okay, I'm doing it because I have to do it. No, actually make money out of it. Then it's about creating the technologies that allow you to do that. For example, carbon capture becomes very important. So let's say with ADNOC and ADNOC Drilling, what we basically kind of have with Emirates Steel is capturing a lot of the kind of carbon, pushing it through pipelines and then re-injecting it into the ground to basically enhance recovery. So you also create an economic activity. So it's not only about, okay, I'm doing it because I have to do it. Then there's an element of I'm doing it because I'm offsetting carbon, I'm making money from the carbon credits. And then there's a third level of actually I'm creating an economic activity where I'm utilizing this carbon, and hence basically I'm benefiting again.
Right.
How much of the sustainability, actually winding it back, a quick shout out for LLMs as well. We have a homegrown LLM called Ittifaq that, we had the CEO on recently. It's about paralegal research, and you should really check it out. You
would love to. I'd definitely do
It's
that.
an early stage startup by Mariam Al-Ansari. She came on for the podcast a few months ago.
Super
So check it out. It's basically automating. You would not require a paralegal if it works out.
Super interesting.
But yeah, in terms of sustainable finance, how much of that? So you're saying, it's really cost saving, and then it's value creation through, offsetting your carbon credits. But then how much of that is also, hey, instead of just cost saving and creating a revenue funnel for carbon credits, we'll also do, for example, what Mazdar's doing, which is ADQ and Wadla, we'll invest into solar and PV and invest into off-grid technology that we can, utilize that solar and sell it back to the government. So how much of your investment philosophy in sustainable finance is actual, and I don't want to get you in trouble, but actual offsetting carbon, and how much of it is just buying into it and making sure that, that kind of washes the bottom line a little bit.
I think ultimately with any new technology, you need to balance, right? Because let's say, for example, if we take example from completely outside sustainability, right? Metaverse, right? When kind of Meta went all into the metaverse in extremely aggressive way, and then that technology hasn't come into play in the same speed they anticipated, that had a massive kind of negative impact on the performance and the share price. But obviously, because at the same time, they've simultaneously invested massively in AI, then AI more than offset that and actually created at the end a very strong positive performance. So whenever you're investing in these new technologies, you have to be investing in multiple technologies at the same time. And you have to not lose sight of the fact that you're still a publicly listed company who has to report results quarter in, quarter out. Or even if you're a private company, you still need to perform. So you need to continue to invest in the future so you don't get left behind, but you also cannot get too aggressive and too quick that your core business doesn't grow or gets neglected, and then ultimately kind of the technology doesn't come into play as fast as you expect. So that kind of dual approach always becomes important. And that's why you'll see like with every, for example, quarterly results and everything, we first reinforce how the core business itself is growing 30% year on year, and then how we're investing. And as we invest, for example, from ADNOC Drilling, yes, our direct investment arm, which is Enersol, we're actually investing in late stage technologies first. So before we get into like some of the earlier stage things, we're doing late stage technologies, which are already free cash flow yielding, which are patented. And hence we're able to get into technology in a gradual way. And that's why it's important to go from like conventional to tech enabled and then ultimately cutting edge tech, right? But you don't want to jump all the way and kind of neglect that transition and then ultimately suffer in the short term.
Yeah, there has to be a preparation or transition phase.
Exactly.
We were speaking about how you transition now, the final stage, you're now the CFO of ADNOC Drilling, right? And typical deal cycles, at risk of being redundant for our viewers, due diligence, execution, your closing, value creation, and exits. In terms of value creation, because you're talking so much about, hey, we got to prepare, there's a preparatory phase and a transition phase, and then you sort of integrate that technology. How much of that value creation is done in-house? Because, the theme is very important. How much of that is in-house and how much of that is outsourced to consultants?
Look, so I think in my mind, both are very critical, right? So obviously what's great about consultants is bringing in the playbook and the case studies and the benchmarking, right? At the end of the day, you have to know what are other people doing and where are the learnings, right? So by definition, your team in-house can tell you what they've done in their previous lives, but they were not integrating another company yesterday because they were here. Right? But the consultants are able to bring into you that benchmarking and tell you what are other people doing. And that's why when a lot of people talk about consulting and the value for consulting, for me, ultimately, it's about the value that you're able to extract, right? If you focus the consulting efforts on benchmarking, on bringing in the subject matter experts they have from their network, etc., then you're going to get immense value from consulting. But if you end up focused consulting on just creating slides and etc., then you're not going to get value. But that's because you're not able to extract the right value. So that's for me what consulting brings. And then what in-house brings is the ownership and the accountability. Because the challenge with consultants is at some point they will transition out, right? They're not here forever. And hence what you want is an internal team that can own this, drive this, and be accountable for it and see it through, and hence have that skin in the game to drive it. And that's why a lot of the consulting also is evolving into the fees being a percentage of value creation, right? And that model is the creating that hybrid model where, yes, on one hand, it's consulting, bringing in best-in-class learning from outside, but then when it comes to implementation, they now have skin in the game and they kind of get compensated based on the actual value creation.
Yeah, it's moving towards an almost either deal value or EV value, right? Like investment banking advisory is. And in this region, you see a lot of PE consulting coming up now with helping sovereign wealth funds integrate to a certain extent. So moving forward to Enersol then. So this is a JV, and so you had a 1.5 billion target. You've finished half of it. Congratulations. And you want to do the other half this year, right? So I think this might have been cut out as well. But in terms of oil field tech services, how much of you scouting out these companies, because some of the acquisitions were, in Pennsylvania, in Texas, and then some of them are regional, right? So how much of you scouting these companies is going out to an investment bank and saying, hey, find me the best, target, or find me a list of indicative targets? And how much is it you understanding the process and saying, we need exactly this for this element or this stage of our process? It could be refinement, could be, the way you do flow process, etc. Because again, coming from a finance background, this must be a big educational gap, I guess. So you have to sit down and understand your process and say, hey, we need to maybe refine this and make this better.
Absolutely. So I think it's a combination of all of this. One is obviously, in order to be able to get something of value, you have to tell people what are you looking for in a systematic way for people to be able to help you. So definitely you need to rely on investment banks, consultants, private equity firms, because you want to, as you said, you want to access deals globally, and you always want to have the widest net possible, because you don't want to go after a narrow number and then you end up with an adverse selection that you're just choosing from whatever you're being shown, and you're being shown whatever deals are left in the market. So you want to cast an extremely wide net using a very wide network, but you want to have a very clear process about what's going to make it through that net and top of the funnel. And that has to be always a combination of strategic and financial criteria, right? Because at the end of the day, you want the product, if it's really strong, it has to translate into financials. It has to translate into a free cash flow if it's late stage, or a very strong growth if it's early stage. It has to translate into a high client retention, a high client MPS, a real differentiation versus competitors, which you have to see through numbers if it's really strong. On the other hand, you want to make sure that these numbers are sustainable and that there is continued investments in the product and the technology that will keep these numbers the way they are, and you're not kind of going off a cliff where the numbers are strong because the technology was strong, but now you're not reinvesting as much as needed, and hence the competition is catching up and these numbers are about to start kind of declining. And that's why combination, and that's why it's all about having the right team, right? So you bring in the financial element, but then partnering with the right people internally and externally who bring the right product, technical, technology understanding to make sure that you have both covered.
I want to slow down the gears.
Yes.
I want to understand, you have read so much in terms of finance, tech, Islam. There's so much you seem so informative in so many aspects of life, right? How much of your daily life, what does your day-to-day look like, and how much time do you invest in reading?
So I read very bite-sized. So I kind of love to read Bloomberg, Deal Book, Wall Street Journal, Enterprise, kind of Reuters, etc. I love to read like bite-sized. I love to read articles, like opinions, top pieces, etc. For me, that's just my style. And other people would prefer to kind of read full books, etc. And you can learn from either, right? Just kind of everyone has a different style. For me, I prefer to read this kind of constant 1 minute, 2 minutes, 5 minutes. And that's kind of easier for me to just constantly plug into my day, because then we just you always have your phone. And if you're able to kind of in every just walk, commute, every downtime, everything, you're getting something, just kind of read a bit. For me, that's what works. And I also kind of love just kind of getting digests and newsletters and emails, because always almost forces you to read. So I sign up to all of these like newsletters, and then I'm just constantly popping up in the inbox, and then you're just flashing through, you're reading a bit of this, a piece of that. So it becomes integrated into your day. As opposed to, it's like, say, a standalone exercise. Okay, now effective, I'm going to read. So I feel that works quite well. And then you can always supplement this with saying, okay, this is a good book. Now I'm going to kind of read a certain number of pages, etc. per day. But I feel that kind of being part of what you do. And then the same with conversations, right? Like, it's because also reading is one side of learning, but the other side is from people. Like every conversation you sit with someone, you learn from them, from what they do, from their interests, etc. So I feel also it's about having as many conversations as possible throughout the day, and just having also the curiosity every time you sit with someone to try to understand what they do and what's their perspective, and learn something from every conversation.
What do you think is going to be the future of finance in quantum computing? And I want to listen to your perspective on quantum.
Look, one, I think like with any new technology, I think there's a few things. One is, that the technology is ultimately here to stay in some form, right? So we've seen this again, whether it's blockchain, whether it's metaverse, whether it's AI, whether it's some of the climate tech, etc. It's always kind of keeps evolving and then stays in some form. So one is, we know it's here to stay, right? Second is, we probably know it's a bit too early to pick winners, right? Because as you said, the stock prices have popped. pop differently between different players. But what you don't sometimes know early on is who's going to accrue the benefit. Is it going to be the traditional player? Are they going to make a move quickly enough? Or is it the new player? If you take AI as an example, right? When it came to the kind of the chips side, it's not Intel that reaped the benefit, it's NVIDIA, right?
Yes.
So in that case, it's not the classic incumbent who benefited, it's more NVIDIA and AMD, so you had the benefit. But when it came to the LLMs, a lot of the kind of benefit is indirectly or indirectly reaped by the incumbents, because at the end of the day today, if you want to, OpenAI is not public, so if you want to buy it, you buy it from Microsoft, and then you have the Meta LLMs, etc., and the Amazon investments. So on the LLM side, it wasn't a new publicly listed company that reaped the benefit or one that's, etc. It's actually the main incumbents that reaped the benefit. So you don't really know who is it going to be in quantum computing. It's going to be existing guys or the new guys. So it's too early to pick specific ones. Then there's the valuations, which, yes, we know if you look at the valuations today, above 100x price to revenue, etc. But we also know that these revenue numbers are not representative of the future, right? Because there's no real kind of monetization. Then we also know that not everyone in the value chain is created equal. So if you look at AI today, from an NVIDIA perspective, the valuation seems to be well justified from a multiples perspective, because they are just selling an insane amount of compute. But if you look at it from like a price to earnings perspective, it's not crazy. Like NVIDIA is trading at 30x forward price to earnings, which is like for a market that averages 20x, to be trading at 30x multiple is not. But the reason they're trading at a multiple that doesn't seem too crazy is because they're getting paid these massive amounts of money from clients, who these clients themselves are not making money yet, right? And these clients themselves, whether it's OpenAI, whether it's Microsoft, etc., but they're able to sustain it because they're making money from other ways, right? So on one level, the infrastructure piece actually makes sense financially, but the end user who's making the infrastructure piece makes sense. That end user doesn't make sense yet, because if you look today at the amount of money that Microsoft, Meta, etc. are spending versus what we as the end users, whether corporates or persons, are paying to Amazon in Meta, Microsoft, that doesn't make sense yet, right? Because yes, you have a ChatGPT subscription, but how much are you making on that versus that you're spending? Same with Meta, etc. So with quantum computing, the question becomes, okay, if I, let's say, provide the infrastructure, but is the end user willing to pay enough for that to sustainably trickle? So I think a very long way of saying is, it makes sense from my humble perspective to bet on the sector, that it will be successful. But it's too early to try to say. So if you look at it, I think you look at it as a basket of saying, okay, this is a quantum computing basket. For example, if you're going to buy stocks, if you own 10, 15, 20 stocks in that, then sure, the basket overall would make sense, as opposed to kind of one specific. Because again, today you'll have a lot of people who will say, but do you really need that level of power? But we had the same exact discussion with GPUs, right? With GPUs, people are saying the same thing. Why do you need that level of power of the GPUs? The CPUs are more than fine. But until you have the use case, but does that use case come in a year, 5 years, 10 years? No one knows. So you need to have the patience, and you need to have that totality basket view.
Is Core 71 already looking into investing in quantum computing?
To be honest, we haven't, because also with Core 71, we also have a mandate around the region. So we focus on companies, because again, it's also a little bit about when you're investing, it's also about access. Every time you invest in a deal, the first question you need to ask is, why am I seeing it? Why did this come to me? Why was this not fully subscribed before it came to me? So because the quantum computing is by definition still very dominant in like very high tech markets, it's more likely that these deals which are really hot and good would be fully subscribed early stage, and we will not see them here. What we're seeing here is things where the sector, for example, why are we seeing a lot of biotech here in the region? Because Cleveland Clinic in Abu Dhabi has become a pioneer in allowing early testing and early admission. So a lot of the actually best in the world biotech companies are coming to relocate here. So there has to be, so we have to have something in the region that allows quantum computing to have an angle for being here. Then we will start seeing high quality deals being available for investment here.
We need a moat for UAE.
Exactly. Exactly.
I think the literature as well as the regulation changes, right? Like there's a literature when you're looking at AI as a new sector, the revenue model is still kind of confusing. People are saying, hey, do we pay per prompt? Do we pay per? So they're trying to figure out the revenue model on the end user side.
Exactly.
And then the way we look at it from a finance perspective is, hey, for example, when PVs became a big thing in continental Europe and here, they said, hey, Deloitte published literature saying, hey, do we do EV to megawatt hours? Or do we do something? So the valuation side of things also needs to adjust. And then
100%.
just threading that line forward, you look at regulation, you say, hey, when wealth management became a big thing, like robo-advisory came to this region, ADGM said, hey, we'll create an environment that allows people with lesser, it's a 19-to-1 debt to equity ratio. So we'll allow people to have lesser amounts of equity in their company, and they can start these wealth management or advisory sources. So regulation also follows suit, right, with literature.
100%.
But just
and to your point, we know that consumers, whether enterprises or customers, love an all-you-can-eat model, and we know that commercially that's the easiest thing to sell, whether it's an all-you-can-watch, all-you-can-eat, all-you-can etc. And the reason software has become so successful, enterprise software, is it brought down its marginal cost so much that it's able to sell this all you can do, and they're able to make the economics make sense. The challenge that, for example, AI has today is because, to your point, the compute and the cloud on the back end is still very expensive. If you try to offer that all you can eat, it can become very expensive for you as a provider. And hence, you're not able to optimize that. And the same on the consumer. The reason that a lot of the B2C consumer plays, which is free delivery, order as much as you want, etc., struggle to make money is because it becomes very expensive. So it's all about how do I bring my marginal cost of that unit, whether that unit is compute for AI or is delivery for B2C, etc., in order to be able to offer what I know is the best commercial model for customers and make money off it.
Yeah, and I think the argument becomes, is it a volume business or is it margin expansion?
Yeah.
And honestly, my perspective would be I'd bet on volume expansion and consolidation any day of the week compared to just margin expansion, because it is a volumetric business that will lend itself to consolidation at some point when a big player becomes established. But I mean, just winding down in respecting the time we have here. Now, Youssef Salim, you being the helm of a corporate company in terms of strategy and mashallah, like a really big oil player in the world, having your hands in startups and entrepreneurship and having a wide net, as you say, or a strong network in investment banking. What do you see the future of the financial industry here in the MENA region?
I think it's super attractive for a few reasons. One is you obviously have financial centers propelling this, whether if you think about kind of the 2010s era, it was all really propelled in the region by the IFC, right? By the International Financial Center, investment banks setting up here, etc. If you look at now, that's still continuing, but then you have EDGM, Abu Dhabi Global Market, right, in Abu Dhabi, which actually have a very large number of funds moving in, etc. And same with Dubai, right? It's not only investment banks setting up anymore, it's hedge funds, it's family offices setting up. Then you have Saudi, obviously with King Abdullah Financial District and all the initiatives there. So for the first time in the region, it's now a multi-hub, financial hub region where you can work in different places across the region, plus obviously Qatar Financial Center, plus etc., Bahrain Financial Harbor and others. So you have much more government support and initiatives coming up. Two is with everything that's happening everywhere else in the world, the financial kind of center and the gravity keeps moving towards the Middle East, right? Because as Europe continues to kind of struggle with thinking about its tax regimes and its regulations and continues to go from one kind of election and deadlock to another, a lot of people are just packing and leaving, right? And they're coming to the Middle East. And as more and more people come, at the end of the day, this is a constant supply and demand, positive reinforcement cycle, right? You bring more talent from Europe and other parts of the world. This talent sets up, comes up with ideas, incorporates funds. You move more AUMs here, you invest, you need more talent, and it kind of keeps going on. So that's kind of, I think, a big positive. Economies are doing extremely well. At the end of the day, your finance is started related to the economies. Capital markets, right? If you look at the 2010s, was really an M&A play and the restructuring play. Today, with the last couple of years and continuing, this is also becoming a massive capital markets play. It started as equity capital markets play, but now even debt capital markets. Saudi is now the record issuer among emerging markets of bonds, right? So you have also a big debt capital markets, which is developing. We talked about, for example, buy side starting to come back. Again, 2010s was mostly about investment banking and then a few sovereign wealth funds. You have more sovereign wealth funds coming up. Sovereign wealth funds are becoming more active, but then you have a buy side industry, which is kind of developing again, whether it's kind of smaller funds or bigger funds. So I think whichever way you look at it, it's very, very conducive for the financial sector in the region developing very, very strongly.
Absolutely. I think we're in agreement on that. And if there's nothing else, we'd like to thank you so much.
Thank you for having me.